everyone, welcome back to my channel, The Learning Path. In this video, I'm going to explain how to work out the closing value of plant in a contract account and how to calculate estimated profit for contracts nearing completion. For more understanding, please click on the cards to watch my playlist of contract costing. Next, check out one problem. The first problem is we are going to discuss how to calculate the closing value of the plant in a contract account. Look at this first problem. Show how you would deal with a plant in a contract account with the following information. Plant issued to contract on 1/3/1989 costing rupees 40,000. So contractor has started on 1/3 1989 with a value of the 40,000 that is going to be debited because this plant is issued for the purpose of carrying out the contract. Then look at the next line. The next line is plant issued to contract, that is 1/3/89 was 40,000. Plant costing rupees 2,000 was transferred to another contract on 31 August 1989. So this amount of plant was transferred to another contract means this amount of plant is not utilized for this contract. So we need to credit this amount 2,000 on the credit side of the contract account. The next thing is plant costing rupees 1,000 was stolen. So this plant worth rupees 1,000 also we didn't utilize for the purpose of this contract. So I already mentioned in the previous videos, whatever materials, whatever expenses that we are incurring for carrying out the contract, that only to be debited in your respective contract account. So this plant is going to be not utilized, that is amount rupees 1,000 was stolen. So we need to credit this item. Another plant costing rupees 500 was destroyed by fire. So this also is going to be credited in our contract account. Another plant costing rupees 2,200 was sold for 2,200. What is the original cost? 2,200. The sold value also 2,200. That means there is no profit or loss. So just we can credit this amount 2,200 on the credit side by plant sold. I mean by bank account. Within the brackets, we can mention plant sold. Look at the next information. Plant at the end of the year was valued by charging depreciation at 10% per annum. So depreciation date is given in this problem on 31/12/19. Ignore depreciation on plant sold, stolen and destroyed. Now we'll move on to the solution. In this solution, as usual, we have a debit and credit side for the contract account. And this the thing contract account I prepared how the plant will appear in the contract account. This is the not a complete contract account, it's an extract, that is extract of contract account. So on the debit side, I mentioned over here what is the value of the plant issued, that is the original value in the plant issued to the contract 40,000. The credit side I mentioned by plant transferred. So how much of the amount has transferred to another contract account? 2,000. So that's what I mentioned over here. 2,000 is the value of the plant transferred. But this plant utilized by the company for how many months? So the contract has started 1/3/8 and we must be very, very vigilant looking at the dates. The contract, on what date the contract has started. So contract has started on 1st March. And this plant costing rupees 2,000 was transferred to another contract on 31st August. So we need to calculate how many months we made use of this amount of plant for this particular contract. So we made use for 6 months. That's what I mentioned over here. What is the depreciation allowed on this amount? So 2,000 into 10% into 6 months we made use. So what is the depreciation on 2,000 means? 100. So after considering the depreciation, what is the original value of the plant transferred to another contract, that is 1,900. next, I credited by P&L account. Why I mentioned by P&L account means whatever plant we lost and we the loss due to stolen or destroyed, that entire loss has to be gone to P&L account. So that's what I mentioned over here by P&L account. What is the value of the stolen plant? That is 1000. What is the value of the plant destroyed by fire? That is 500. So total loss to be debited in your P&L account is how much? 1500. So next is by bank. I mentioned over here the sold value of the plant as per the problem. That is another plant costing rupees 2200 was sold for 2200. So there is no profit or loss when we are selling this value of the plant. So just we credited this transaction by selling the value of what is the value of the plant, that is 2200. In case if you are having any profit or loss means profit to be debited, loss must be credited. We have one more problem like that we will discuss in the next problem. So I think you understood the first three transactions on the credit side. The last transaction is on the credit side that I mentioned over here. This is the closing value of the plant. So what is the closing value of the plant? How to calculate the closing value of the plant after considering the above information? So we need to first write what is the plant value when it is issued for the contract purpose. That was 40,000. From that amount, we must consider what is the plant lost due to stolen or destroyed. We need to consider and get the balance. And minus plant transferred, we need to show. Please make it in your mind. Plant transferred, we need to consider the cost price only. Look at that. The cost price was 2000. You should not commit a mistake by taking the written down value of the plant transfer, because we are going to consider depreciation again. So show the cost price of the plant transfer 2000 and get the balance 36,500. Then what is the value of the plant? Again, what value only we need to consider? Whether we are selling the plant at a profit or on loss, we need to show only the cost value. The cost value is 2200. So what is the value of the plant at last means we got it as 34,300. So on that, I will apply depreciation 10%, but it for only 10 months. Why it is for 10 months? Just look at the problem. The contract has started on 1st March only, but the contract was ended on 31/12 itself. So how many months? Only 10 months. So 34,300 is the value of the closing plant. On that, depreciation is 10%, or 10 months means what is the depreciation on the plant end value? 2,858. So the balance of the closing value of the plant, we got it as 31,442. So this is the way how we have to work out the information pertaining to the plant in the contract account. So debit, what is the value of the plant we received during the time of contract. Okay, then consider the information given in the problem. Is there any plant lost due to the fire or stolen, or any plant transferred to another contract account? Consider the dates. Consider the dates. That is very, very important, because we need to apply how many months we made use. So in this problem, we made use this transfer plant only for 6 months. So out of 2,006 months, depreciation is 100, means what is the written down value of the plant transferred to another contract. So this is the way how we can work it out, the closing value of the plant for the first problem. We'll work out one more problem. That is, a plant costing rupees 1,50,000 was issued to contract on 1/4/2010. Plant costing rupees 10,000 was transferred to another contract on 30/9/2010. So when you're reading the problem, check out the dates, on what date the contract has started. Okay. So as for this problem, the contract has started on 1/4/2010, but the plant costing rupees 10,000 was transferred to another contract 39/2000, means we need to calculate how many months we made use of this particular plant worth rupees 10,000. A plant costing rupees 5,000 was stolen like the previous problem. Another plant worth rupees 4,000 was destroyed by fire. Plant costing rupees 3,000 was sold for 4,000. Look at this problem. It is slightly different from the previous problem. A plant costing rupees 3,000 was sold for 4,000. So is there a profit or loss? It's a profit because the cost is only 3,000, but we sold it for 4,000, means there is a profit on sale that amounts 1,000. That is 4,000 sold value minus cost value is 3,000, means we add a profit in this transaction. So debit the profit and credit the sold value of the plant. Okay, and charge depreciation is given 10%. Ignore depreciation on plant stolen, sold, destroyed. Show the extract from contract relating to plant. Now look at the solution. In this solution, we have as usual columns, debit and credit side. I debited plant value when it is issued for the contract purpose, that is 1,50,000. And then I debited one more item. This is a profit on sale. Why there is a profit on sale? I explained, because the cost value of the plant is 3,000, but the sold value is 4,000. There is a profit. So all profits must be debited. In case if you are getting loss, means you please credit the loss. So as for this problem, I'm getting a profit on the sold. So 1,000 is the profit. Now move on to the credit side. Buy plant transferred, 10,000 is the value. But I made use of the plant for 9 months. How I got 9 months means, now look at the problem. 4th, that means April month. From April to that is September. So September month means, so how many months I made use? So April, May, June, July, August, September. So we made use, sorry, I will wrongly mention here, that is 9 months. Now look at this problem. That is 1/4/2010, 39. So April, May, June, July, August, September, 6 months. So 6 months we got it as. So what is the balance here? That after the depreciation, 9,250. So we calculate the what is the value of the plant transferred after the depreciation. The next is by penal account. What is the stolen value of the plant and destroyed value of the plant? As usual, we need to show in the credit side. And by bank, the sold value of the plant. What is the value of the sold? Sold only we need to show. So sold value is 4,000. Now, finally, we have to calculate what is the value of the plant at the end. Plant issued during the time of contract, 1,50,000. And as usual, deduct the stolen value of the plant, value of the plant destroyed, and what is the value of the plant transferred to contract. But please remind, you need to show the cost value only. And what is the plant sold? Again, I said cost value. What is the cost value? 3,000. So that 3,000 only we need to consider and deduct. And then what is the value of the plant at the end? 1,28,000. On that, depreciation is 10%. So 12,800. So 1,15,200. So 12,800 is the depreciation, because the information, we are very clear, the information is 1/4/2010. So we calculate, assume that that contract is ended in the next year, 31/3/2011, and then we need to calculate for the whole year. 12,800 means what is the value of the plant at the end? 1,15,200. So this is the way how you can show the values of the plant in a contract account. I think all of them understood. By looking at this two problems, solution 1 and solution 2, you will come to know how to show the values of the plant in both debit and credit side under a contract account. Next, we'll move on to the problem. This problem is relating to how to calculate the estimated profit. Where this term will come in your contract account means, when a contract nearing completion, around 90%, the contract is going to end, the contract is going to complete, means we need to calculate what are the additional expenditures that a contract is going to incur for finishing the contract. In that way, we need to estimate the profit also. So in that situation, how to work out the estimated profit. So this problem is going to deal about how to calculate the estimated profit and how much of profit will transfer to P&L account. Now look at the problem. Given below our contract price, work completed, estimated cost to completion for case 4 only, and notional profit for 4 cases. Compute the amount of credit that can be given to costing, profit and loss account. This is the problem. Now we have 4 cases, cases 1, 2, and 3, and 4, and their respective contract prices. This is the contract price for the problem, and work completed for the first case is given 4 lakhs and notional profit is given. Likewise, we have all first 3 cases, but in the 4th case, we have the contract price is 20 lakhs, work completed as 18 lakhs, estimated cost. I said no. Whenever a contract is nearing completion, the contractor usually estimate the cost, additional cost that is going to incur for finishing the contract. In that way, he calculated what is the cost to be incurred for finishing the contract, and that was given in the problem as 1,60,000. The notional profit for the 4th case is given 3,60,000 plus profit on work to be completed. So this is the problem. Now we'll discuss how to deal with this kind of problem. Now, before going into solution, look at this format. How I'm going to calculate the estimated profit. How to calculate estimated profit means the formula. That is, this is the formula that many of them are using. That is estimated profit into work divided by contract price. So, how to calculate this estimated profit? Look at this small format. Check the notional profit. So notional profit as per the contract account. And with this, you need to add the additional profit on balance work. How I will calculate the additional profit on balance work? Look at this. Total work to be completed. Then add the estimated cost along with the work to be completed. Then get the total value of the work. Then compare the value of the work with the contract price. You will come to know what is the estimated profit. So this is the formula how to calculate the estimated profit. So how to calculate estimated profit? Compare the contract price with your value of work. Okay, then you will get one information. Then this additional profit to be added along with the notional profit means then you will get estimated profit. Again, I'm telling the notional profit to be added along with the additional profit. How to calculate the additional profit for the balance work means have this small format. What is a work certified? That is total work completed plus additional estimated cost. Then get the value of work and compare the value of the work with the contract price. You will come to know what is the additional estimated cost. So additional estimated cost, compare with the notional profit, then what is the estimated profit. Now we'll deal the cases one by one. The case 1 is contract price is 20 lakhs. Contract price is 20 lakhs. The work certified is rupees 4 lakhs, which is less than 25. When you're seeing the amounts itself, you will come to know, you will get an idea what is the percentage of work certified on the contract price. Work certified itself 4 lakhs, but the contract price was 20 lakhs. So by seeing the amount itself, we'll come to know the percentage is less than 25%. So as per the golden rule, the entire notional profit will kept under reserve. No profit will transfer to P&L account because the percentage is less than 25. Now look at the case 2. The contract price is 20 lakhs. Work certified is 6 lakhs. When you calculate the work, again I'm telling as per the previous videos, contract price is always assumed as 100%. If 20 lakhs is equal to 100% means 6 lakhs is equal to question mark. So we'll come to know 30%. So 30% means that falls on the second golden rule, 1/3 rule. So here the cash receipt is not given means don't worry. You just take the notional profit of that particular case. Notional profit was given. The notional profit was 1,20,000. So notional profit 1,20,000 into 1/3, 40,000. So how I got this 1/3 means as per the golden rule, because the percentage we got it as 30%. So 1 by 3 into 1,20,000, 40,000. Next, we'll move on to the third case. The third case, as for the third case, the contract price is 20 lakhs, the work certified is 12 lakhs, which is 60% on contract price. So definitely we need to apply the 2 by 3 rule. So what is the notional profit given for the third case means 2,40,000. So 2,40,000 into 2 by 3. What is the that is profit transfer to P&L account? 1,60,000. Then we'll move on to the last case, case 4, the contracts which are nearing completion. Work certified is 90% or more on contract price. Therefore, the amount profit transfer to P&L account is, look at this working notes, calculation of estimated profit. Notional profit as per the last case is given as 3,60,000. The last case notional profit is given 3,60,000. So, and then I need to calculate the additional profit on the balance work. Total work completed is 18 lakhs as per the problem. Look at that. The work completed is given 18 lakhs. Estimated cost is 1,60,000. So work completed is 18 lakhs. Additional estimated cost is 1,60,000. So what is the total value of the work completed? 19,60,000, which has to be compared with the contract price. The contract price was 20 lakhs. So what is the balance I'm getting? 40,000. Price is 20 lakhs, but the value of the work is 19,60,000. What is the profit behind that? 40,000. Already the notional profit is 3,60,000. Along with this additional profit 40 means what is the total estimated profit? 4 lakhs. So apply in this formula how much of profit transferred to P&L account. So 4 lakhs into work certified. Work certified is given in the problem is, so now look at that, work certified 19,60,000. We calculated the working notes 19,60,000, and then contract price was 20 lakhs means how much of profit transferred to P&L account? 3,92,000 only. Out of 4 lakhs, only 3,92,000 will transfer to P&L account. The remaining balance will be put it under reserve. I hope this video will help to understand that how to calculate the closing value of the plant and the estimated profit for contracts nearing completion. If you want more videos like this, please subscribe, share, and comment below. Thank you for watching. Stay home, stay safe.